Good morning, friends. Welcome to Ecoholics YouTube channel. My name is Avinash Agarwal, and in this video, I'll be discussing with you important current affairs for 3rd June 2024. So let us start. The first article is pertaining to India's debt scenario. This is a very beautiful article. It will give you a very deep insight into what is happening in the Indian economy so far as our debt position is concerned, particularly our external debt position. And typically we are used to thinking that India's debt position is very comfortable, external debt position. This article will help us develop a very nuanced understanding of what is exactly happening so far as that is concerned. So let us start. So this is an important number that I want you to note down. So India's external debt is 18% of its GDP. And the finance minister Nirmala Sitharaman, she is right in pointing out that this number 18% of GDP, it is amongst one of the lowest in the G20 economies. So this is very reassuring, is what you need to understand. But you have to also understand that this external debt, it is only a part of our external liabilities. You have to look at the complete picture. That is what the thrust of this article is going to be, and that is what the new part of this article is going to be. Good morning, Charulata. So the important point over here is that you have to track India's international investment position. This is what you also should be able to track. Apart from our external liabilities or external debt, you should also be able to track India's international investment position. This will tell you what is the stock of international financial assets and liabilities at a point of time. We are essentially talking about the entire set of assets and liabilities vis-a-vis the rest of the world. So on the assets side, you will look at all foreign financial assets that we are owning, right? We will also be considering international reserves held by the central bank. So when we are talking about IIP, that is the international investment position. From the assets side, you will look at all the foreign financial assets Indians own, as well as international reserves held by the central bank. When you look at the liabilities side, right? So you will look at the entire stock of direct and portfolio investment that is coming into India. You will look at the entire external debt that we are owing to the rest of the world in the form of bonds, loans, deposits, trade credit. So all of these aspects need to be simultaneously looked at. Okay. So essentially what I have done is that in the last 1 minute, I have painted the entire picture of balance of payment ka asset side and liability side in front of you. I hope that that part is clear. If there is any doubt, please ask. Now, there is another term that you should become familiar with, and that is NIIP, that is Net International Investment Position. The difference between the asset side and the liability side, that is the net international investment positions. Whether the world owes to you or you owe to the world becomes clear from this net number. If this net number is positive, that means that the world owes to you, so to speak. If this number is negative, then you owe to the world. Okay. Now let us understand where we stand so far as our NIIP, that is Net International Investment Position, is concerned, right? So our net international investment position is negative, that is we are net in debt. If you look at this period of 2003 and 2023, and I want you to note this down, right? So our net liability, it went up from $60 billion to $396 billion. It went up from 9.9% of GDP to 11.1% of GDP. I want you to note down this number. This is going to be very helpful. So whenever you encounter a question vis-a-vis external debt, not only will you have this 18% of GDP number that we spoke about earlier at the start of the article, but you should also be able to add more nuance to the discussion by talking about NIIP, that is Net International Position. If we compare ourselves with the rest of the world, so US is the most indebted country, Japan is the largest creditor, we are somewhere in between, right? Now, how is NIIP created, or what are the various flows that impact NIIP, right? So we have to look at current account flows very closely to understand what is happening. Before we move ahead, I just want to give you a sense of what current account means. So in balance of payment, there are typically two accounts that we talk about. There is a current account and there is a capital account. In current account, we are capturing all trade related flows, right? So whether it is goods trade, it is captured in current account. Whether it is services trade, it is captured in current account. So apart from goods and services, there is another third component which is captured in current account, which is the flow of remittances, right? So that is also getting captured in current account. So all the import and export related flow of goods is captured in current account. All the import and export of services related flow is captured in current account. All the inflow and outflow of remittances, gifts and transfers is captured in current account. Okay. So this is the brief definition of current account that you should be okay with. If there is any doubt, please ask. Okay. So let's talk about current account. So there is a consistent deficit here in current account, in India's current account, because of the fact that we import a large amount of goods, right, as compared to what we export. So the consistent deficit here, it leads to a negative or lower NIIP, right? So that is where one of the problems lies so far as India is concerned, so to speak. We have to try and encourage greater amount of exports from India. We are already having a surplus so far as the services account is concerned. We are exporting far more services than what we are importing, right? We are also having a surplus on the remittances or the transfer payments account is concerned. We are receiving a lot more money than we are sending out. So within current accounts, three subcomponents, that is services and remittances, we are positive. But on the goods part, we are negative, and that drags India into a current account deficit. And since there is a deficit on the current account, okay, so then we have to, necessarily try and attract funds on the capital account. So we acquire capital liabilities, we encourage foreign capital inflows into our country, right? So if you look at net exporting nations are typically strong export powerhouses due to a variety of reasons. So like for instance, Japan is a very developed economy, a very advanced economy in terms of manufacturing still. South Korea has caught up with, let us say, countries such as Japan and Germany quite nicely in the last 25 to 30 years. Saudi Arabia is a very big exporter of petroleum, raw material, crude oil, etc. So net exporting nations, they have a higher NIIP, means let us say a more positive NIIP, right? They are having trade surplus. They earn more money from abroad, and then they use this money to buy foreign assets abroad, right? So we can try to get into this leak by encouraging a lot of manufacturing, a lot of exports from India, right? So this is what I have already discussed with you in the last 5 to 7 minutes. So you see India's assets and liabilities. So this pink line over here, light pink over here, is India's liability. This dark blue line over here is India's assets, and the difference between the two is this net asset minus liability position. So you see that our net asset minus liability position is in the negative zone. That is what we have discussed. We don't need to be too worried, because there are a lot of other countries who are far more negative than we are. For instance, Indonesia, Turkey, France, UK, Australia, Mexico, Brazil, United States of America, they are deeply into the negative territory as compared to, let us say, us. Okay, so let's talk further, right? So when we speak about our international investment position, right, so that's basically the balance sheet of the world. That's what I'm saying, that we are continuously using the word balance of payment, right? So essentially, this is a new way of talking about what is happening vis-a-vis your balance of payment in a way, right? And I haven't discussed this particular concept so far in the last 25 to 27 lectures that I have taken. So this is a very new thing that I'm discussing with you guys. Okay. So when you break down assets and liabilities, right? So we don't need to be too worried, right? We have a huge foreign assets. We have foreign exchange reserves, right? And this is providing us a cushion against any kind of exchange rate mobility. So if you compare India's position with our neighboring countries, or India's position with 1991 position, or India's position with any country, similar country in the rest of the world, so you will see that our foreign exchange reserves totaling up to nearly $600 billion, that is quite good a number, right? We will be able to take care of any kind of volatility in the exchange rate market. If let us say suddenly our exchange rates exchange rate starts depreciating, RBI has enough firepower that they can sell, let us say, foreign exchange in the market and control the depreciation of rupee. So we are sorted over there. If there is, let us say, a sudden appreciation of Indian rupee, then RBI has enough firepower that they can buy a lot of dollars or foreign exchange from the market and they can stabilize the currency. So that part is sorted. Another thing that is very helpful for us is A, political stability, and B, good economic growth in the present and in the future that we are projecting. So in that sense, we don't need to be really worried, right? You may contrast our situation with that of an Argentina. Foreign assets, they consist of privately held foreign debt, which is again a very, very risky position to be in, privately held foreign debt, right? So why has that happened? Domestic capital has fled to safer shores abroad, right? So this is a very risky situation to be in. People don't trust in your economy. People don't trust in the management of your economy, which is why you will see that the domestic capital will fly away to international shores and then be, then be recorded as privately held foreign debt, in the sense that those organizations and individuals within Argentina, they are basically showing the money that was in-house as now being in the foreign country and now being privately held foreign debt, right? Liability side of India, of our balance sheet, that is dominated by FDI, and that is also long-term investment, and that is having a stabilizing effect. So FDI cannot be pulled out suddenly. You are aware of that, I'm sure. Foreign portfolio investment or institutional investment may be considered as hot money, but FDI is very, very safe, very, very long term. It creates jobs, it creates R&D, it creates knowledge, it brings, best manufacturing practices, best R&D practices, and so on into your country. So FDI is really fantastic, right? So on the capital account side, the fact that FDI is quite dominant is again very reassuring for India, right? So half of the liabilities, they are in nature of debt, but the share has declined over the past decade, right? If you look at the debt side of liabilities, right, that has declined. And I'll tell you why. India as a country has been very mindful of taking on any kind of external debt or any kind of sovereign external debt. We have been very, very mindful of that, because 1991 crisis taught us a bitter lesson that if you become indebted to, let us say, foreign parties or to foreign agencies, then they can arm twist you into, accepting their policies as your policies. We don't want to be in that kind of a situation again, which is why we have been very, very mindful in terms of not taking on a lot of external debt so far as our sovereign is concerned, at least, right? So there is a strong link between high external debt and external crisis, and we are saved in the sense that our external debt position is very much in control. Okay, now this is the liability side of it. As you can see, when we talk about our liabilities in this particular, so you can see that this is direct investment, significant part of it. This is portfolio investment. Again, this is hot money, but given the stability in India's growth story and political stability that we are envisaging going ahead, this should be fine, right? And then the remaining part is the other debt. Okay, that is the other debt. Moving ahead, India pays far more to foreign entities than it earns from overseas assets, right? Investment income credit and investment income debit. So if you see India's investment income debit, so that is growing, and if you see investment income credit, so you see that that is small and not growing so fast. Let me explain this particular graphic to you. Let me put this in perspective. So imagine that you are owner of, let us say, land and let us say factory abroad. Okay, so basically, or an enterprise abroad. So if let's say you are owning land or a factory or an enterprise abroad, okay, so you will get rent, you will get profits into your country from abroad, because you will earn those interest and profits abroad, and you will basically repatriate, or you may bring it back into your home country, is what you would typically do. So investment income credit means that you have invested abroad, you are generating an income abroad, and that income is getting credited from abroad into India, right? So that is happening, but it is very small. You compare that with investment income debit. So foreigners have invested in India. Let's say that they are owners of land in India, owners of factories in India, owners of enterprises in India. They are generating income in India, and that income is getting repatriated abroad. So in that sense, some amount of money is coming into India through this channel, but a lot of money is flowing out of India through this channel, right? Why is that happening? Because Indians have not yet, really gone abroad and acquired a lot of assets like maybe other countries have done, let us say in India. So that is what you need to understand over here. So on the asset side, we accumulate foreign reserves, and our foreign reserves, they are invested in safe, low yielding treasuries of advanced countries. So all the foreign reserve that RBI is sitting on, what does RBI typically do with it? Invest in US bonds and so on, right? On the liabilities side, we bring foreign investment through equity capital, right? So long debt, short equity position, right? So our earning on overseas investments, they are lower than dividends and interest paid to foreign investors. See, what are we doing? We are investing in government bonds of, let's say, US government and so on. We get very, very nominal returns on that. Whereas people who are investing in India, what do they invest in? They pick up equity in Indian companies, or they invest, they become owners, 100% owners of companies in India, or let's say 51% owners of companies in India, etc. So they get profits and dividends. So these enterprises, these companies, they are risk-taking, profit-making institutions, right? They become market leaders in India, maybe in the rest of the world. So they are able to generate significant amount of wealth for their owners. So you see what is flowing out is quite significant in terms of profits, dividends, etc. flowing out of India. And what we earn from abroad, for like I explained to you, that a huge part of our foreign exchange reserve is invested in government securities. Our interests, our returns are nominal, right? So the difference is negative for India, and the difference has been increasing, right? As more and more foreign capital inflows into our country and becomes owners of profit-making assets, right? So this difference is becoming larger and larger. So in 2023, India paid $80 billion and got $55 billion as investment income. There is a gap, clear gap of $25 billion, right? So this net negative investment income, right? This is a second issue which is dragging us overall into negative, our overall balance sheet into negative. So we have a trade deficit, which is something which drags us into the negative territory so far as balance of payment is concerned. And then there is this net negative investment income, which is dragging us in the negative, right? So in that sense, we need to, be a little cautious over here, right? Coming ahead, so investors, they are less tolerant of external liabilities in low income countries, right? So because ultimately we are trying to get a sense of your repayment capacity. Now India doesn't have a problem over here for sure. We have always been able to repay our debt, and we have always repaid our debt. Going ahead as well, we will do that, right? So external crises, they are more likely in lower income countries, right? FDI is definitely an exception, right? So emerging economies, they rely on direct investments to finance domestic growth, because direct investment is more long term, more stable, right? Rich countries such as, let us say, those in Europe, those in North America, they can get away with large debt driven external liabilities, right? Because they are having trade surpluses, they can sell bonds. They are having trade surpluses, so they earn a significant amount of money on current account. They can sell bonds because people believe in their macroeconomic stability, people believe in their political stability and so on. So they can mop up money quite easily. So they can go down this large debt driven external liabilities route, but not so much for developing countries, not so much for low income countries. If you look at India's per capita income, it is one of the lowest in the world. We will be talking about that in the second article as well, right? So to always remember that foreign capital inflows, they are a liability, right? And definitely we are an attractive destination so far as an investment point of view is concerned, but we must never forget that these capital flows, they need to be nurtured, they need to be safeguarded, otherwise they can be reversed at any one point of time, right? India's growth potential, India's inclusion in the global bond indices, right? This will bring in more amount of inflows into India, right? We have to balance the country's external liabilities and assets, right? And we have to boost exports and improve our current account. So the takeaway is very, very simple. The takeaway is not difficult at all. That try to export more from India and B, maybe what we should try to do is that we should try to increase our investment income from abroad. There is a very clear, thought process amongst a lot of people in India that India's foreign exchange reserves, they can be put to better use in terms of generating a better return on investment, right? Whether RBI goes down that route or not, that can always be debated. But there is always this idea that what RBI can do is that they can park their money, or they can give that money to, let us say, enterprises who can then make, let us say, significant investments abroad which generate a decent amount of profit and dividends. It's a very debatable idea, very controversial idea, but there are a few articles on this aspect. But I hope that you understand about India's international position much better, IIP. I hope that you understand the net international position of India much better after this article as compared to before the article, right? And the external debt part is also very clear to you. Okay, so moving ahead to the next article, this is going to be a breeze. Now everything going ahead is going to be super easy now, because the first article was pretty heavy and quite technical in nature. The second article or the third article that I'm going to discuss is going to be fairly straightforward. Okay, we are going to talk about India's GDP growth rate, which has been quite fantastic in the last financial year 23-24, right? So we are going to contextualize that growth rate and what that means, and it will also be talking about the challenges that India face going ahead. Okay, so like you all are aware that NSO has released this data that India has grown at 8.2% in 23-24. So yes, the data will be revised. It may come down a few notches, it may go up a few notches, but this is a very good and healthy number, especially given the fact that RBI was looking at only a 7% GDP growth rate as late as December 2023. So this number is decent. This number is quite good, right? Like I said, that no matter how you slice and dice the number, this number is good. It shows that India's growth story is real. It shows that India's growth story is broad-based, because like we discussed in the last week, whether it is manufacturing or mining or construction or services, all of these sectors and subsectors have been firing quite significantly in India, right? So we had 8.2%, 8.1% and 8.4% of growth in the first, second and third quarters of last financial year, right? And we were expecting our growth rate to be somewhere in 7%, but we actually got 8.2%, right? So there is a lot of growing optimism that, we are nearing a takeoff stage, right? Recently I discussed in the last week one article with you that S&P Global Ratings, they had also upgraded the outlook for India, right, from stable to positive. They hadn't changed India's credit rating, right? We are still, from a credit rating point of view, just above the junk grade, right? Or we are at the bottom of the investment grade from a credit ratings perspective. But from an outlook perspective, for the next 2 to 3 years, S&P Global is looking at India and saying that the momentum is definitely positive. The growth momentum is definitely positive. If you look at International Monetary Fund's assessment of April 2024, so they are also talking about the robustness of growth. They are also talking about the strength in domestic demand and a rising working age population, right? So you may be tempted to think that we are near the takeoff stage, that we are just a hop, skip and jump away from prosperity, right? That we have really arrived, our moment has really arrived, right? But you have to be mindful that this can be converted into wishful thinking very soon if you change the data point, right? So if you forget the growth rate and you talk about the per capita income of India, then we are still at number 144 in the world. You take the entire national income of the country and you divide it by the population, you will get something called as per capita income, right? And that per capita income rank for India is 144. We are behind Uzbekistan, Papua New Guinea and countries such as Angola. It will be only by 2029 that probably we will be able to march ahead of these countries. Definitely we have been marching ahead. We were at 153 in 2018. Today we are at 144. Going ahead, we may be somewhere close to 135 or 130 in the next 4 to 5 years, right? But we are still very much below where we want to be, right? So this is the challenge that we have to take up. So while the growth has to be there, it has to be cheered, it has to be applauded, it has to be broad-based, but we have to also ensure that it is inclusive, it is sustainable, it is long-lasting, because if we are able to grow at these rates for the next 10, 15, 20, 25 years continuously, then we will be able to make a serious dent on our per capita income ka rank. That is the takeaway from the second article. The third article gives you a very clear sense of what is happening so far as inflation in India is concerned, right? So in this article, I'll be talking deeply based on data about what is happening in inflation, right? You don't need to completely rote learn or completely try to memorize all the data points, but you need to have a fair sense of where we are coming from and where we are headed, right? So the point is that MPC will keep the now we are what we are doing is that just before the Monetary Policy Committee meeting, right, the Mint newspaper, they have done a poll of 10 economists, and they say that the repo rate will remain unchanged at 6.5% for the 8th consecutive time, right? Because inflation is still not in control. That is what we are going to conclude out of this article. So to make your and my life easier, I am just concluding that right off the bat, right? So whether you see food inflation, right, so that's pretty high, 8.7%. When you look at retail inflation, we are still at 4.8%. RBI's mandate is to bring inflation to 4% plus or minus 2%. So this doesn't mean that inflation can be allowed to hover at around 5% and say that we have met the target. The targeted rate of inflation is 4%. So you have to bring the inflation to 4% is what RBI has been reiterating of late in its monetary policy meetings. Okay, and core inflation is around 3.3% in India. So you can see that that's on a downward trajectory. That's, in my opinion, the only good thing out of this particular graphic so far as inflation is concerned, right? So we are assuming based on what economists are thinking, that the benchmark interest rate and the policy stance that will remain unchanged, right? Because inflation is very much out there, it is not yet controlled, right? We are still expecting a 6.5% ka repo rate, right? And policy stance unchanged at withdrawal of accommodation. So slowly and steadily, RBI is withdrawing all the all the steps that they had taken for expansionary monetary policy earlier. So we are withdrawing accommodation, we are withdrawing liquidity, we are withdrawing all of those things from the larger macroeconomy, right? So we will be going to neutral in the second half of the year is what we are expecting, right? So monetary policy stance can be offering accommodation, neutral, and withdrawing accommodation, right? So we are right now withdrawing accommodation because we want to pull inflation down, right? And once inflation has been controlled, then we can go into the neutral territory, whereby we are neither going big bang on expansionary monetary policy. That means we are putting money into the economy so that we can stimulate growth, nor are we going big bang on the contractionary monetary policy, where we are pulling money out of the economy so that prices can be controlled. We will try to stand somewhere at the interface of both these policies, is what I mean by neutral stance going ahead in the second half of the year, right? So Shaktikanta Das was seen comparing inflation to elephant and saying that elephants move slowly, so you will have to be patient, right? And the last mile of disinflation. What do I mean by disinflation? Please understand this term very well. So if, let us say, your inflation is behaving like this, that it is 5%, then it becomes 4.8%, then it becomes 4.75%, 4.7%. So this kind of a trajectory for inflation is referred to as disinflation. So inflation is very much positive, but it is declining, right? The trend is declining from, let's say, 4% to, let's say, 4.5%. So the last mile of disinflation is always challenging and sticky, is what Shaktikanta Das was seen saying recently, right? So the monetary policy meeting is going to happen on 5th to 7th of June. So I'll again come back to you and discuss whatever they have discussed on 7th of June. So that is going to be a longish discussion, because I'll discuss the entire monetary policy discussion with you guys. So it is going to be a very long lecture, right? So if you look at the GDP print, so we are moving faster than what RBI expected, right? So there is no reasons for RBI to be urgently cutting rates, because the GDP is already performing well. Had the GDP numbers not been great, growth rate numbers not been great, then there would have probably been a more alarming situation for RBI to reduce the interest rate to boost economic growth and so on. But the economic growth is already good, so why should there be any urgency? So we will definitely try to tame headline inflation, right? So RBI will so somebody Rahul Bajoria, who is head of emerging markets at Barclays, So he's saying that given that the fact that the growth rate is already good, right? So there is not going to be any emergency situation for RBI to reduce interest rates. So they are going to take their own sweet time, right? So whether it is consumer price index, we have brought it down, right? Whether it is core inflation, we have brought it down, right? But the food inflation bit is something that we need to tackle. That is what is coming out of this, right? Outlook for prices of foods and commodities, right? So that is suggesting a status quo on rate and status quo on the monetary policy stance, right? There is a higher than forecast expansion in the Indian economy, right? So the stance may change going ahead, right? But there is no reason for us to change stance now. Okay, so this is the broad takeaway from this article. We are always going to get an opportunity to discuss actually what happens, when RBI's monetary policy committee does come out with a decision. So we don't need to discuss too much into the depth of what people are speculating is likely to happen, because we are already going to do a discussion what actually happened on, let's say, 6th or 7th of June. So I think this is about it from my side today. We have spoken about our debt and balance of payment position in depth. We have spoken about what is happening in India's growth rate a little bit in depth, and we have also seen what is happening so far as the inflation position is concerned. So I hope that this was very clear to you, right? I will meet you all again and take this discussion ahead. So until then, I will bring this session to an end. See you tomorrow, guys. Thank you so much. All the very best, and Jai Hind to all of you. Take care.